Hi guys, welcome to our YouTube channel. Thank you so much for watching this video. This is the first time ever that we are posting a video on the Windrose Capital YouTube channel. So really excited. A quick introduction. I'm Rohit Goyal, the managing partner at Windrose Capital. Of late, I have found many interesting queries regarding the startup ecosystem and the VC industry. So I've decided to try something new here. What we are doing is we are opening the sort of discussion up and are answering the top questions that we get in an Ask Me Anything format. So regularly we will be sort of asking for more queries. So please feel free to post in the comments below. Um, or you can send me direct messages on LinkedIn as well. And the top 10 questions is what we will take up for each AMA session, so on and so forth. So yeah, look forward to an engaging session with you guys. Further ado, let's begin with our questions for today. The first one here: what should a pre-MBA undergraduate do non-professionally to build or ready himself for a VC role in a few years, other than keeping up with the startup ecosystems update? That's a good one. The best thing to do actually is to just talk to a lot more peers, talk to people who are already working in the industry in various capacity, be it analysts, principals, or whatever designation. Just look in your school's alumni network, and just talk to as many people from the industry as possible. I'd recommend don't stop after speaking to just two or three people. Just talk with a lot more. Try creating diversity, because that's how your sample set, so to say, would expand. Speak to people from the north, from the south, from outside India as well, uh, and wherever else. Because the your perception of a life inside a VC industry would take a drastic shift, right? And then it is up to you to then decide whether or not it's a life that you want, and whether it aligns with your personal aspirations. Moving to question two: how do you decide, this is the one that I need to invest in? Ooh, that's a big question. I could speak on it for days, but in interest of time, I'm going to try keeping it short here. Different VCs or investors have their own approach. I'm going to elaborate on what we do at Windrose. What we are doing is, what we've observed rather, is that we end up investing only in like a single digit percentage of all the companies that we evaluate. Being an early stage investor, the number of companies that we see through every month is quite high, and we realized that we do spend a lot of time saying no rather than saying yes. So we went on optimizing that for our own internal operations, and decided to go a via negativa type of an approach. So what we do is, whenever a mandate does come to us internally, we have got two sort of set of filters, which are just to identify reasons to say no. So if we are seeing any glaring issues with it, maybe the mandate does not fit into our investment thesis, maybe the check size is not in alignment with where we want it to be, uh, maybe the stage of the company is not where we might want to participate in. All those things gets filtered out first. uh, with these two filters, usually about 80% of the companies that apply to us get rejected at one of these two stages. After that, what we do is we actually end up meeting with the founders one on one. So we do a meeting only when these first two internal stages of sorts are completed. Now, this meeting is actually the time where we start finding reasons of why we should invest. Before this, we were only evaluating for why we shouldn't invest. Uh, and the interaction, how it goes with the founding team. Again, when it comes to early stage investing, your business model can pivot, your sector might be realigned or whatever, but your founders never change, right? So we weigh in a lot on the kind of people or the kind of conversations we have when we interact with those founders. And afterwards, we sort of step back, look at the holistic picture here, and then take a call. So very honestly, as a VC, it's not just, oh, I love them, I'm going to invest in them. It's not a split second decision. It has to go through a much more rigorous process, because again, VCs themselves are answerable to their investors, and they need to rationally document the rationale behind each investment that they make. I hope this gives some clarity to this very, very deep question. The third one, and this I believe is one of my favorite ones for today: what is the most underrated trait of an entrepreneur or an investor? One word answer: discipline. uh, Discipline, I believe, is so underrated. I couldn't emphasize more on it. In fact, to share a fact with you all, we at Windrose, we have an investment thesis, so which is a document that guides what sort of investments we would make, what sort of investment we shouldn't make. The cover page of our investment thesis has a quote by Warren Buffett. And the quote is like this: we don't have to be smarter than the rest, we have to be more disciplined than the rest in order to be a successful investor. And we draw a lot of our working philosophy from this particular statement. And I believe it holds equal weightage when from an entrepreneur side as well. I believe having discipline is one of the most key things, not just entrepreneur, in fact, for like investors, entrepreneurs, and any leader in their life. Moving on to the next question. What do you prefer, a natural interest of an entrepreneur towards a problem statement but a dull communication, versus a sharp communication but an artificially curated interest? Ideally, I would prefer natural interest along with sharp communication, which wasn't an option given here. But usually, what we do then seek is, maybe not one individual has both this skill set, but as a team, these skill sets should exist. Of course, there is more inclination towards natural interest of an entrepreneur, because the dull communication is a problem that could still be solved, but one with a sharp communication but with really no alignment with the business problem, that's not a solvable issue anytime soon, though, unless I don't know the founder has some epiphany. So ideally, we would want to see both in format of the founding team, but of course, there has to be a genuine reason or a drive for founders. In fact, we specifically look for disproportionately mission-driven founders, as we call them. So these are people who are driven by their mission to achieve something, and for them, achieving that mission is sort of the purpose of their life. And we really love such entrepreneurs. Uh, Moving forward, question number 5. From a portfolio perspective, how do you identify outliers? Is it revenue, valuation, combination of different matrices? Ah, okay, so there are two ways. I I personally refrain from identifying outliers within the portfolio, because very honestly, an outlier qualifies to be an outlier when they have given us a great multiple return. In which case, the act of determining whether they are an outlier or not would make them go out of our portfolio. So yeah, in actual sense, only companies that have generated great multiple returns are what can be identified as outliers. Having said that, there are a lot of indicators that one's portfolio company might show whether they can be prospective outliers. Now, while investing, we want to select each company within our portfolio with a potential of being an outlier of the portfolio. Having said that, there are again leading business matrices, revenue, valuation, both of them are one. And it is very company specific. If you are an ops heavy company, you would probably also have some operations parameters, some capacity utilization or team size parameters that would sort of be more relevant. Basically, when it comes to outliers, I believe one should refrain from counting your chickens before they are hatched. So being quite pragmatic, I would only identify outliers once they have generated the kind of return for the fund. Going next is, during evaluation, what are your defining requirements and how are they different between a B2B and a B2C company? Okay, so there are two questions here. First are the defining requirement piece, and then the difference between B2B and B2C. Okay, so I'll just quickly list down largely four, so to say, defining requirements. I've already mentioned a few of them before. I'm going to start with those. One is whether or not the company or the business has disproportionately mission-driven founders, which are people who are really driven by the mission or the purpose of the organization itself. This one I had covered before. Second one, again, the one which I had covered before, is whether or not this company could become an outlier within the portfolio, in the sense, can this give us a very good multiple return? So these two are the ones that I had mentioned before. Another two pieces which we definitely see in each of the companies that we invest in is a defensible moat. So whether your business is or your business strategy is defensible, and does this moat grow with time, or does it reduce with time, or how does this moat change? So we do a lot of or we try to understand a lot around that part. And last but not the least, of course, is sensible unit economics. So we do understand that at early stages company may not be profit making, but is there a clear path to profitability? Is there a size, a quantum, a timeline, so on and so forth defined to reach sustainable unit economics? So those are as far as the defining requirements are concerned. Now, these requirements are not different between B2B or B2C, but the parameter or matrices that determine these requirements may change, right? Like from a B2B company, you might want to look at different parameters when it comes to unit economics or strategy, and B2C company, you might have to look at different sort of financial matrices altogether. But the defining requirements for us remain the same, irrespective of whether the business is to like a direct to consumer or whether it's a B2B business. Moving forward, for VC investment perspective, I just want to understand that a sustainable and profitable business model attracts more, or VCs always look for high scale at initial stages. Sustainable businesses can also be scaled at a later stage. That is not an issue. This is a good question again, and one which some founders fail to understand. I don't know why. So let me begin by saying something which you might not hear very often. Good businesses need not always be VC backed. At the same time, like no investment from a VC does not, or it's not a statement on the quality of your business or a quality of a founder, right? Not every business is VC investable. Simply because for a business to be VC investable, it also has to align with a VC's own business model. You need to see that VC themselves are in a business of their own. Their business has their own business dynamics, which imposes certain type of restriction on what kind of companies they can invest in and what kind of companies they cannot invest in, right? And hence they are very, very uh, different approaches. So never link uh, like the quality of business with whether or not it is VC backed. Sustainable businesses, as mentioned, can grow later by different form of financing, right? VC or any equity financing is probably the most expensive type of financing. If you have a sustainable and a profitable business, chances are you would have access to cheaper capital as well. Now, coming to understanding the VC model, you need to understand that for a VC, we work on a portfolio of investment model, right? We understand that some of our portfolio companies will fail, and hence for our fund at large to succeed, we definitely need multi-baggers within the portfolio. What one needs to do is also understand what is the business model of a VC, right? So when we are investing in a portfolio of companies, being very well aware that some of those companies may not make it through. And it may not be because of a mistake of the founder or of the business model. It's just that early stage companies are exposed to a lot of external uncertainties which they cannot control, like change in regulation, uh, or change in the trend within the sector, or just a competitor with like substantially much higher funding coming into play and like is just playing the price war game, right? So we need to understand that in order to make up for those losses, VCs need to have multi-baggers within their portfolio. And while investing, we don't know which those multi-baggers are. So by definition, we would want to seek that each company that we invest in is a multi-bagger, which basically sort of forces the need to scale. Now, the scale can come in whatever format. It could be in revenues, it could be in size of operations, it could be in valuations. But at the end of the day, what VCs are looking for is whether or not this particular mandate can be a multi-bagger within their portfolio. If it is not, then it really does not make sense for a VC to invest. So a lot of times founders do feel that, oh, I have a profitable and sustainable business model, but why is a VC not backing me? Uh, so I think this should sort of clarify. Again, I'd like to reiterate that a VC rejection is not a comment on the business quality. Having said that, there are business models which are sustainable, profitable, and scalable, right? If you have such business model, please do reach out to us. We would love to evaluate your business and seek a partnership with you. Okay, coming closer towards the end here, equity dilution among family and friends at an initial stage is a big problem for VCs. Or can it be managed and considered as manageable? Generally, first time entrepreneurs are not that great at managing it. So answer may give a lot of guidance to them. Okay, so the primary concern here is around dilution. One needs to understand that dilution in reality is not our concern as an investor. What is the basic issue around here is the drive of the founders. Now, there is an underlying belief amongst all investors that if you don't have enough share of the pie, you are not driven enough to grow the pie, right? And in that context, if you look at it at a very early stage, now VCs are looking for high growth companies that can scale faster. The likelihood is that you will require multiple rounds of funding. So at an early stage, if you've already given out a lot, what it indicates is that you will not have enough left on the table for yourself to be driving you through. As long as the drive problem can be solved, it really doesn't matter dilution or so on and so forth. To give you an example, one of our portfolio companies, in fact, one of from a previous fund, we invested in a company that was created by a promoter entity, but was led and professionally managed. Right, so the management altogether had less than 20% equity allotted to them. Of course, there was some more ESOP remaining, but there was a different set of promoters, whereas the management was very different. Having said that, the roles, responsibility, the motivational drive, etc., was fairly well aligned. So we absolutely had no issue investing in those companies as well. Now here, like I'm not just talking about family friend, but a third party, right? So we have a different set of promoters and a different set of entrepreneur who's actually running the show. So that's also okay. One needs to understand that what is left on the table from a future perspective also has to be significant enough for the entrepreneur to sort of drive them. It's very common to see in late stage companies, like, even in the likes of, let's say, Flipkart, founders individually held about single digit percentages in their company, right? So that's perfectly fine at a later stage, but early on, uh, like, because the pie is already small, and if you hold a smaller chunk of the pie, then as the pie grows, you are really not capturing as much value. So just sort of to ensure that the drive is on, the mission of the company is fulfilled, we usually prefer sort of companies where high initial promoter holding or founder holding is there. Coming to a penultimate question, how do you find your ideal co-investor? We go out and search for them. But ideally, what we'd like to do is seek people with expertise or people who could plug in the gaps that would help the particular issues that the company is facing. Mm, So, of course, we seek co-investors who are professional, growth-oriented, do not have any alternate agenda on table, and just basically people who can bring in true value and not just the check. In fact, to give an example, one of our current portfolio companies, we are a lead investor. We were the lead investor in their previous round. We had a right to nominate a board member. We actually elected another co-investor who was a much smaller investor as compared to us onto the board of the company, simply because we recognize that that person can add a lot more value to the company than we can, as in beyond just the capital part of it, right? And the last one, oh, this is also a great question. What should a founder look for in an investor? The most obvious answer is check, but the intent of this question, I believe, is beyond check, right? So, what beyond capital? This is a fantastic question. In fact, I ask all, like anybody who's met me in person for an evaluation, towards the end of our meeting, I always ask the founders or prospective companies that, what is it that you're looking from us beyond just the check size that we want. And usually, smart founders are looking for, how can you help us grow our business? How can you help us build a correct network or give access to a correct network that you might have, or any sort of guidance or advisory. Sometimes it is on specific topic. Like as a fund which invests a lot in tech, I've got a good tech partner as well on board. So a lot of our portfolio companies go to him for advice on technology, so on and so forth. So you should always evaluate what is it that beyond capital that an investor is bringing in, right? Because if somebody is willing to invest in your company, the check is something which is okay. What value can you take more? Other than these, ideally, I would recommend go for investors who are transparent with you, who are available and accessible to you, and as well as people with whom you see a good personality alignment, right? Because see, any engagement with an investor is about like a multiple year deal, so to say. So you have to sort of live with that investor for a longer period of time. So it's also good to, at times you might end up befriending the investor, or whatever, relationships evolve in different manner. But having a good alignment at the beginning is very helpful. So yeah, I think that sort of completes the first AMA session. Thank you again, everyone, for watching this. We would like to bring more value to you, so I would request you, please put in your comments below, ask us more questions. You could also follow us up on LinkedIn. My LinkedIn profile as well as the company's LinkedIn profile are mentioned in the link below in case you're watching this on YouTube. If you are on LinkedIn, then you already know how to find us. I'm happy to receive direct messages from anyone. So yeah, please do comment and like and subscribe to the channel if you feel like. Thank you so much for your time.